Welcome back. So we've talked about the funding landscape. Now we're going to talk about determining your capital needs. So as a startup, how you fit into the capital pipeline. So raising money is expensive. What this means is there's a cost of capital associated with every dollar that you raise for your startup. So if we take a look at this chart, when you're an early stage startup, it's a fairly high risk profile. What that means is that the investor is looking at the team, at the market, at the technology, at the adoption, and they're unsure if it's actually going to work. So as the risk is high, that investor is willing to put low amounts of money, small amounts of money to work against a high risk profile company. Now, as the entrepreneur de-risks parts of the business, as they prove that the team is smart, as they prove that they can build the product, that people will adopt the product, that people are willing to pay for the product or service, then the investor has greater and greater confidence that the business is going to work. So the risk is coming down. They're willing to put more and more dollars to work against a decreasing risk profile. And as they do this, they're willing to own less and less of the company because they perceive it to be less and less risky. So if we take a look at this chart, investors are putting small amounts of money to work against high risk profiles. And then as the company is able to de-risk certain parts of the business, as they're able to test a hypothesis and prove that something is true and create less risk in the business, then the investor is willing to put more and more money to work as they do that. So this is staging of investment. This is Series A, Series B, basically around the entrepreneur testing different hypotheses and proving that their product or service is going to work. So as a rule of thumb, as the entrepreneur, you basically want to raise the minimum amount of money at the high cost of capital in order to get to the next step where you've reduced risk. The reason you do this is because the cost of capital is high when the valuation is low. So early on when your company is risky and the investor is giving you a lower valuation because they don't know what it's worth, the cost of capital for the money you raise is going to be fairly high. So as you reduce the risk, as you test these hypotheses, for the investor, your valuation is going up, the risk is going down, and therefore they're able to invest more and more amounts of money against a decreasing risk profile, and they're able to do this in a way with confidence that brings the cost of capital down for you. So in a nutshell, this is why investors are staging dollars in. Basically, they're putting seed capital to work when they're first testing out an idea. As the entrepreneur de-risks parts of the business and they prove that the team, the product, the market, all these things work, then the investor is willing to put bigger dollars to work in the form of a Series A and then the form of a Series B. And even though these check sizes are larger, they're typically coming at less and less ownership positions because the valuation is increasing. So as an entrepreneur, it really behooves you to identify a hypothesis. So what this means is figure out what exactly you want to test. Then figure out what will it take you to prove this hypothesis. So this could be traction, this could be technology, this could be market adoption, this could be a number of different things. And then what you want to do is think about the costs that you will incur per month in order to get there. So in testing a hypothesis, it might be that you want to build a product, test early adoption, and figure out if you can get the number of beta customers that you believe you can. In order to do this, you might need 12 months or 18 months of runway, and you have an implied cost per month that it's going to take to get there. So these are the various things that we want to talk about. So first, let's talk about cost per month. Basically, add up all your costs per month. So this could include, your monthly rent, employee costs, development costs if you don't have in-house technical support, and all of those. This is together combined called your burn rate. And your burn rate is basically the amount of money it costs per month in order to keep your business running. So as you think about your hypothesis, as you think about what you're looking to test in order to de-risk your business, increase your valuation, and lower the cost of capital for raising more money, you want to think about how many months it's going to take for you to prove your hypothesis. Now this is called your runway. So it's a very simple formula that you need enough runway given your burn rate so that you can prove out your hypothesis before you run out of money. So what does this look like? In a nutshell, basically, if you needed 18 months to prove that your product or your market was going to work, and you had $50,000 per month in burn rate, and this is paying your rent, paying for your computers, paying for your internet, paying for various development services that may or may not be in-house. Basically, if I had a product that I needed 18 months in order to test, and it was costing $50,000 per month, this implies roughly a capital need of $900,000. Now, given that everyone under the sun makes mistakes, and given that investors realize this, it's really smart to buffer in an amount of money that allows you to make some mistakes. And this is perfectly fine to admit to an investor that you're not going to get it perfect and that you believe that you can test a hypothesis. It's going to take 18 months. It's going to cost $50,000 per month, which implies $900,000 in order to run this test. And because you think, you can't get it perfect every time, you're going to buffer in $100,000 just to be safe. So in this example or this scenario, we would need $1 million in order to test our hypothesis successfully over an 18-month period with a $50,000 per month burn rate. So in this case, this is basically what we've talked about. $1 million would get us 18 months of runway on a $50,000 burn rate with $100,000 of buffer just in case. So framed another way, if we think about the cash we have in the bank divided by the burn rate, that gives us a runway that we could effectively spend building this company or testing the next hypothesis. So in this case, if we have $1 million in the bank and we have a burn rate of $50,000 per month, we've effectively got a runway of 20 months in order to test. To sum that up, basically, we want to ask the really big question. We want to test a hypothesis. We got to determine our burn rate. We're going to determine the runway required in order to have that burn rate and test a hypothesis. It's going to take some amount of time. And this implies our capital need. And so this is the basic amount of money we want to ask for first when we go to whether it's an angel investor, a seed investor, a venture capitalist, because we realize that the early capital that we raise, because the risk of the business is high, that capital is going to be very expensive. So we don't want to raise too much just for the sake of raising it. We want to raise just the right amount that we can test the specific hypothesis that's going to be able to de-risk our business and enable us to increase our valuation so that when we raise money the second time, we can raise it at a higher valuation and a lower cost of capital. So this gets into kind of Eric Ries' lean startup philosophy, where we're going to build, collect data, test hypotheses, set tactics, measure, run experiments, reset those tactics, reinform our strategy, iterate, learn, repeat, and scale, right? So we're running experiments, we're setting tactics, we're defining strategy, and we're basically rinsing and repeating, meaning we're doing this over and over and over. So as we test different hypotheses, we're just trying to de-risk elements of our business so that we can increase our valuation, and for every new amount of money that we raise, that can be raised at a lower cost of capital. So basically, in the repeating process, we do this as a seed, where we're doing an initial test and hypothesis, in a Series A, where we're finding our product market fit, in a Series B, where we're finding a repeatable sales model, in a growth equity round, where it's really more about execution and scale, and then hopefully in an IPO, an initial public offering, where we really scale and get capital to reach a worldwide audience. So as your homework for Module 2, I'd like you to think about the hypothesis that it would take for you to de-risk an element of your business, what your monthly burn rate is, and what runway you think you would need in order to successfully test this hypothesis. And this will imply a capital amount that will also inform kind of where in the capital pipeline you should be thinking about pitching. So thanks for Module 2. Take a little breather and we'll be back shortly.